Venture Capital Trust, VCT, provider Downing is launching its first investment trust aimed at the UK microcap space and targeting annual returns of a whopping 15%. The Downing Strategic Microcap Investment Trust, due to begin trading on the 9th of May, will be run by highly regarded manager Judith Mackenzie and will have a similar investment process to her current open-ended fund, Me Downing UK Microcap Growth. The trust, which hopes to raise £100 million at IPO, plans to have a more concentrated portfolio featuring 12-18 companies with market capitalizations of less than £150 million. It will take strategic positions of between 3 to 25% in each firm. Downing says it will mitigate risk by carrying out extensive due diligence, coupled with proactive engagement with the management of investee companies. Ben Yeasley, investment director at Advisor Wealth Club, says this concentration is closer to the private equity, or even VCT world, than a typical investment trust. If the right companies are chosen, he says, this will help magnify gains. Choose the wrong ones, though, and losses will have a bigger impact on the overall portfolio. However, he explains, Judith Mackenzie has an excellent record in managing this type of investment, managing an existing microcap fund, which will have some commonality with this trust, and also managing AIM-listed stocks in the Downing 1 VCT. I think it was 2014 when Judith's existing fund was the top performer of all UK funds, about 500 in total. We'll get the full investment policy in a prospectus expected to be published in late March, but Downing says its team will look to be activist in its approach, employing various strategic mechanisms including restructuring boards, aligning incentive packages, recapitalizing and funding acquisitions for growth and/or synergies. Mackenzie, who joined Downing in 2009, will be assisted by Alex Wood, James Lynch and Nicholas Hawthorne. She says the closed-ended structure will enable the company to align the interests and investment horizons of both investor and the fund manager. She adds that there are attractive investment opportunities for experienced, long-term investment managers who carry out detailed due diligence and who can devote time to understanding a business, its markets and its management team. Our investment process should enable the trust to mitigate much of the perceived risk in quoted smaller companies, she says. Companies with a market cap of under £150 million, and particularly those under £50 million, lack analyst coverage and institutional attention, which drives pricing inefficiency and, therefore, attractive valuations. In addition, there is a wider universe of microcap companies, therefore we believe there is a wider opportunity compared to those companies with larger market capitalizations, as microcap companies tend to be better value. Yeasley says investment trusts are ideally suited to investing in a private equity style, as it allows the manager to truly back the underlying companies for the medium to long term, safe in the knowledge that their capital isn't going to be taken away at the wrong time in the cycle through investor redemptions, as could be the case with open-ended funds. Larger stakes in companies can be bought, helping ensure better access to management and influence over the future direction of the business, he adds. You do need to be a patient investor, though, as private equity isn't typically a quick turnaround story. Thank you so much for watching this video. Goodbye.